Welcome to the latest edition of The Bull, the Bear, and You as we navigate what is happening in the economy and we take a look at investing. I'm Stacy Smith, and I urge you to subscribe or say that you like this podcast on whatever platform you happen to use. Well, the markets move up and they move down, but the overriding theme so far for the first half of this year has been moving higher. And it's not just the big tech companies. Smaller companies have been moving higher as well. We'll take a look at that and where and how you should invest. What should we expect for the second quarter earnings? And the saying used to be, there's an app for that. Maybe the new saying should be, there's an ETF for that. We'll talk about that and more coming up in this edition of The Bull, the Bear, and You. And with me to talk about the economy and investing is my panel of financial advisors and experts, and they are Carrie Coghill of Coghill Investment Strategies, also Frank Rossetti. Frank has his own alternative investment company, HF Management Company. Joining us at the table also is Kim Forrest of Boca Capital Partners, which she helped to found. Also seated at the table is Michael Godwin of Fergasso Financial Advisors. Michael is the Chief Investment Officer for Fergasso. Thanks for joining me. I hope you all have air conditioning because it's a hot week this week, at least here in the Pittsburgh area it is. Now, let me begin by saying that all of the major indices are up for the year. And for the quarter ending June 30th, the three major indices are up double digits. The NASDAQ around 20%, as a matter of fact. Now, having said that since the last time we met about 2 weeks ago, the S&P 500 and the NASDAQ have both, for the most part, been in a sort of holding pattern, I'll call it. The NASDAQ in the last 2 weeks has been down about 3%. The S&P 500's lost about 1.5%. Now, last week, both of those indices posted 5 straight days of declines. As we have seen, though, time and time again, those losses can be made up in just a day or two in the volatility with this market. But here's what I also find interesting. Both of those indices are comprised of larger companies, and hence a lot of weight to tech and AI-related stocks. And while those stocks have taken a pause, I'll call it for right now, the index that is comprised of several thousand smaller companies, the Russell 2000, keeps moving higher. It gained 1.5% in the last 2 weeks, and on Monday, along with the Dow, it set another new all-time closing high. And while all of the indices once again are up for the year, the Russell 2000 is up a whopping 21.25% for the year. So is this an indication of what portfolios should reflect, or am I just too enamored with numbers?
I'll say it. You're too enamored with numbers.
Okay, thank you, Frank. We'll move on.
Portfolios are hopefully and should be diversified pools of different asset classes.
Didn't you love the lead-in I just gave to you guys because you love diversification?
And that being said, part of it will be in small cap, part of it will be in large cap, part of it will be in large cap value, and we could go on. And part of it will even be maybe in bonds and fixed income, all of which hopefully will operate differently, kind of like elevators in a large building where they're going in different directions all the time.
You know, I think that the what's underlying the issue, and I agree with Frank, you're too enamored with numbers. So you might want to move on. But I think that the interesting thing about it that a lot of people think we as advisors should know is what the market is going to do. When you look at diversification, and that's the bigger question, why diversify? I mean, if we knew that small caps were going to be up this much, or we knew that tech was going to be up as much as it has been, then that's a different story. But we as advisors are trying to create consistent results for our clients out of a market that is highly inconsistent. And the way that you can achieve results in that area historically has been through proper diversification and asset allocation. We know that over time, when you diversify and you invest in different categories of the market, whether it be bonds, stocks, small cap, large cap, those sectors move for different reasons. And so there's a process, and we've talked about it a little bit before, called portfolio optimization, where we look at the percentages in different asset classes and try to consider economic conditions and how those asset classes will work together. And that's really what we're looking at. So, people become enamored with the numbers because they expect that someone's going to be able to predict this. So, diversification is really important when you look at what we as advisors are trying to accomplish for our clients.
I think what's interesting, getting a little more nuance into your question, Stacy, is we've become so enwrapped over the past 5, 6, 7 years in the Mag 7. We all know what those are. And it's interesting, and maybe it's a good thing to see this year that they are drastically underperforming in tech and the market in general. I mean, Microsoft, Kim would know better than I. Microsoft's down like 15% or so year to date. Tesla's not doing, there's a number of them that aren't doing so great. So it's nice to see a broadening out of the performance, whether it's industrial, energy, etc. It is a little concerning on the tech side to see some of those chip makers up 700% over the past year or two. So there might be a new Mag 7 more or less coming out. And then when you look at the small cap side of things, Stacy, what I find somewhat concerning there, you could break down small cap into profitable companies and non-profitable companies. Over time, the profitable companies should always outperform. The cream should rise to the top there. But over the past year and a half or so, you've been seeing the non-profitable companies continue to outperform on the small cap side of things. So as an investor, that is something I would be paying caution to if you're going to be investing in the small cap side of things, and where you're going to be allocating your money. I still think over the long haul you want to be invested in quality companies down there.
Okay, I have to ask, I'll get to you in just a second, Kim, but I have to ask, if a company, you're saying that some of the non-profitable companies are outperforming, how can that be if they're not making the profits?
It's all coming from the multiple. If you think a company has, and Kim could probably answer this better than I can, but if you think a company, don't nod your head, Kim, I can answer it.
I have the answer. Ooh, but go ahead.
No, if analysts think the prospects of a company's growth are going to be there in 5, 6, 7 years, they're going to be willing to pay up for that growth, even though it might not be there yet. Now I will let Kim finish up that thought.
Great. I love being the cleanup batter. And by the way, go Pirates, go Buccos. I am like all in this year. They're going to break my heart, I know, but
Yep, they will.
Okay. Anyhow, so biotechs have largely been the things driving small caps. And those are companies that are pre-revenue for the most part, which should be terrifying as an investor, because you are definitely buying a lottery ticket unless you're like an immunologist or a microbiologist or something like that, where you really understand the mechanisms and who's good in this area, who's not good in the area. So biotechs have been just on fire because a couple of them have, gotten products pretty close to, being sold. And what does that mean? They're going to get sold to a pharma company. So that is a big driver of small caps. But I kind of love small caps. I love medium caps, right? Because those are the companies that are small but mighty. They generally, the profitable ones, have a system for creating new products, keeping their customers happy, growing their customer base. So they either grow into large companies or they get bought by large companies. So that is a lot of area. If you are a stock picker, you can go hunting there for some really good companies that you can, I wouldn't say you ever feel safe necessarily, but these are companies that know they're owned by shareholders, they have good financial metrics, they're not close to running out of cash, rarely are danger signs there. Getting back to your bigger picture question, absolutely no one forecast what happened in this quarter. It was a very, very hot quarter for many reasons. And as much as we like to pretend, and we being the stock pickers, I'm an asset manager, so my role is very different than both Carrie and Michael. But securities matter, right? Having the right stock selection matters. And nobody really knows what's going to happen in the future. We have a pretty good idea. We use diversification to allow us to perform over many cycles. But let's not kid ourselves. No one knew this was going to happen.
All right, I have to ask this question. There are large companies and there are small companies. What, in your estimation, makes a difference between a large company and a small company? Is it gross
Market
revenue?
cap. What?
I said, is it gross revenue? What is it?
Oh, it's market cap. That's what we're talking about, market capitalization. So that is the price of the stock times how many outstanding shares. And they are the diluted shares. Those are the ones that are on the books as well as the ones that are out there free floating. So that's what we're talking about. So a company like Microsoft that is in the trillions, and let's say a local company around here that makes train parts that are in the tens of billions, those are big companies, but one is bigger than the other, right? And you would expect them to behave differently than the other, which they do. They have different management, we'll put it that way. It's not better or worse, but they're solving different problems.
All right, now, when we get back to the small cap stocks for just a second, are they divided into sectors similar to the larger caps? And then, so can you then buy an ETF with the smaller cap stocks?
I'm out on that question. I don't follow ETFs.
Certainly, there's more ETFs than that.
Yeah, you can.
They're all
Yeah.
sliced and diced. Pretty
Right,
much any way you
yeah.
want them. You can buy gold. You can buy small cap. You can buy small cap growth. You can buy companies that are making drones. I mean,
That is true. I mean, what Frank just said, it's fascinating. There are more ETFs than there are actual stocks in the U.S. market, which is crazy.
Mind blowing.
Yeah,
it is.
it's well, and they'll find a way. Somehow somebody's making money through all of this, aren't they, Carrie?
Well, they're
Yes,
making
well,
money.
and when you, yeah, it's it's just an interesting dynamic. I think a couple things about this conversation. One is when it comes to ETFs, just like you would be looking at sectors of the large cap market or the S&P, it's the same thing. It's just, as Kim said, the companies are smaller, which means that different economic conditions affect them differently. Interest rate changes many times affect small caps more than large caps. Inflation, consumer spending, some positive, some negative. So looking at a small cap company, you really have to look at the fundamentals. And as Michael was saying, which of these companies are actually profitable? What does the competition look like? There's a lot that goes into analyzing different segments of the market, large cap, small cap. To the ETF conversation, this industry is really transitioning from actively managed mutual funds to exchange traded funds or ETFs. So we are seeing a huge move to, say that an index or an ETF that tracks something can do it with less expenses. That's really one of the benefits of an ETF. The other thing is that tax consequences, you have a lot more control over your tax consequences. But I would caution people, as Michael was saying, the reason why there are more ETFs out there than stocks is that they come in all different shapes and sizes with different objectives. And we are very cautious about some of these leveraged ETFs. So you have ETFs that borrow money and reprice every day. The average consumer doesn't really understand what they're getting into. It's, again, a little like gambling, right? Like big wins, big losses. So the market for ETFs is actually becoming a little more complex. I just wouldn't be racing out there and blindly buying something because it has ETF next to its name.
This may be a really dumb question, but I'm very good at asking dumb questions. Is there a chance that the tail wags the dog in any of this? In other words, can the ETF make a change in how the underlying stocks are doing?
Yes,
They're
they
talking about that
can.
right now.
This,
Go ahead, Kim. I
yes.
know where you're going.
So there are some crazy instruments out there, they're probably an ETF, that is tracking a single stock. And you would say, well, why wouldn't I just buy the stock? Well, let me tell you, it's because they're doing crazy things like inverse. So let's say I want to buy an inverse Tesla. If Tesla goes down, my inverse Tesla goes up. Does
So they're
that sound
shorting.
like a good idea? No. No.
No?
No, because somebody is buying and selling Tesla for no obvious reason other than people have put money into their vehicle. So they have to do the math and buy the appropriate amount of shares and the options. And this is a hot mess that's going to explode at some point in the not too distant future. And shareholders or ETF holders, would they be shareholders? I don't know. I guess, share of ETF. They are going to pay the price because a lot of these smaller companies don't have the financial wherewithal to be trading how they're trading. And yet the SEC allows them to proceed.
Okay. I want to move on here just a little bit, but and despite what all of you have just said about predicting the markets, I have to ask this question because I'm I'm back on my numbers again. At this point, last year, for the first half of 2025, the Dow, the Nasdaq, and the S&P 500 were up 3.5% to 5.5%. And by the time the year ended, those indices were up 13 to 20%. For the first half of this year, they are up between 7 and 11% for the year. And in other words, they're a little higher compared to last year. So that leads to this question. As you all gaze into your crystal balls, which all of you say you don't have, with half the year to go, do you anticipate similar gains for the rest of this year as happened last year?
Can I say what a wise stock prognosticator said once when asked that question, maybe 100 years ago? When he was asked, and I think it was J.P. Morgan, but it doesn't matter. He was asked what he thought the market would do, and his answer was, the market will fluctuate. That's it. Can you hear me?
Okay.
It will fluctuate.
Yep, we can hear you. You just stunned all of us. That's all.
Profound. Right, thank you. I think the market will fluctuate, Frank. Yes. I've been on record saying for a while. I think the economy is still fairly strong. Consumers still fairly strong. Unemployment's still pretty good. But I also think that and I've thought this for a little while, that we've gotten ahead of, over our skis a little bit in terms of market returns and market performance. A lot of this has been driven on AI. We all know what the memory chips and the chips have done over the past year or so. It's really good to see that the market can continue to do well and hold up when the big players struggle. The Microsofts of the world struggle, Apple struggles, Google, whatever. I think that's really, really healthy and great. But I do not expect to see a back half of the year in 2026 like we saw in 2025. I just don't. But again, I don't have a crystal ball. I'm not going to predict it. I think I hate using the word volatility. I mean, it's just as cliched as diversification, but it's hard to have a run up like we've had over the past few years, where valuations have gotten to where they are. Earnings have done a fantastic job of keeping pace with that, so valuations haven't really gotten out of control. But again, things are looking good, and when things look really, really good, it's hard to exceed those expectations going forward.
So I'll set this question. This answer will help set up a question about earnings, which I know is coming. So, I'm going to take the easy road out like the guys on this panel and say, yes, volatility, and no one can predict. So the bigger question is, well, what are we watching? What are we watching that would cause us to want to rebalance a portfolio or, get in or get in terms of adding money or, rebalancing to fixed income or wherever else. And it really has to do with, in my opinion, these July numbers economically are going to be a big deal. Because when you look at the impact of higher energy prices and the amount of time that it takes to actually filter down to the numbers, we're starting to hit that point. Now, energy prices have come down just more recently, but I think these numbers are going to be a little more telling in terms of the real impact that higher energy prices may have had over the last several months. The market, as Michael was saying, the market is the valuations are high. It's priced to perfection. So any little thing that happens that is kind of off target could really lead to some added volatility. I think that we also have to pay attention to the things no one is paying attention to. In the past, we've talked about private credit. And today we talked about the impact of some of these ETF products. And if we start to see some real volatility in the market, that's going to further exacerbate the challenges that some of these products have. So you always have to have kind of a view of caution when you're dealing with the market and making sure that you're just not overexposing yourself to risk.
Cleanup batter.
I agree with what everybody said, especially Frank. Things are going to go up, things are going to go down. Again, I have a different view. I'm supposed to have a different view than everybody else on this panel. I'm looking at my little collections of stocks and the strategies that I run, and I'm happy with them. I don't know what's going to happen with them, but I think that they are set to outperform their peers, which is what I'm trying to do, is put a collection together of equities that can outperform their peers. I don't know when anyone is going to really outperform. No one does. So what do I think going into this back half? I agree energy prices are coming down, and I still feel that the Fed is undecided about which way it needs to go. So I think they're going to pretty much tread water and not change interest rates until things become patently clear. When is that? I don't know. So looking at the companies, I think we could still go higher, but maybe not mirror what has just gone on. We could drift higher, let's put it that way, and close the year out with some ups and downs, volatility, good days, bad days. But I think we drift higher through the end of the year.
All right, you mentioned about energy stocks. Energy prices either coming up or going down. Which kinds of stocks does that really affect? Is it the consumer-related stocks, or does it affect all of it? It wouldn't seem like it affects the chip makers and all that right now.
I don't know. Everything has like a little thread of energy in it, right? So I think the chip makers who can make a chip that uses less energy, they go to the head of the queue there for what their customers are demanding. So energy really is subtle, and it doesn't hit all stocks at the same time. The consumer is sour for paying $4 or $4.50 to $5 a gallon of gas, at least around us. So, that's going to affect consumer-oriented spending. And businesses are always trying to pinch pennies and return shareholder value, whether or not they're public. They're owned by somebody, and somebody needs to make a profit off of the company. So energy really does matter in more ways than most people think.
All right, Carrie, you said we were going to talk about this, so let's do it. And once again, it's a numbers question to a degree. Second quarter is coming to an end as of today. Your thoughts about earnings coming up for this quarter when they're reported in July?
I mean, I'm kind of like Kim. Like I make the popcorn and watch my computer. It's really important. And it's really important to dig, right? Like, I think that earnings are probably still going to be in line with expectations. I mean, again, I'm like really prognosticating here, but I don't necessarily see any wild blowouts. However, what we really look for during earnings season is guidance. We really look for, a kind of under the numbers, what's going on. And for example, what has the impact of energy been on companies and how leadership is utilizing AI, how some of these companies that are right in the thick of AI, how that is going to provide a return on capital. So there's a lot that there's a lot to look forward to in terms of this earnings season, and hopefully getting some guidance and some clarity on, what's really going on.
It's not just energy that's, the number one cost impact for a lot of these companies. I think one thing we also need to keep an eye on is, chips in general become ubiquitous across pretty much everything we do now, and the supply chain there has become very, very bottlenecked and very, very constrained. And you saw that a week or two ago with Apple's earnings report, and the fact that chips have become a lot more expensive and harder for them to get, so they're now raising their prices on the iPad and the Mac, etc. And that's going to have a flow down effect to possibly other consumer goods as well. So something to keep an eye on in next earnings season.
So
Great.
I look at cash flow a lot. And right now, the trailing cash flow, free cash flow on the Standard & Poor is somewhere between, and this range coming back just boggles my mind, between 25 and 40 times. Any of those numbers is high, historically high. And now the free cash flow is after they spend money, which is probably why they have that range. They're not quite sure how much money Google and all these AI guys are going to spend, because they're measuring it in hundreds of billions, if not trillions of dollars per year. And that's sucking off a cash flow, and they're actually borrowing money, which creates interest expense. And then they've got to create revenue out of this stuff, which I still haven't seen any big revenue generator out of this. So and they're a big piece of the earnings pie. And it's one of the reasons those stocks have traded down. And if that permeates and the other stuff doesn't pick it up, we could see earnings come in a little short of expectation. Wouldn't shock me. Of course, after all these years, nothing shocks me.
So real quick, you love the Dow, Stacy.
No, I
Did
don't.
you realize Google got added to the Dow? And I
Yes.
think it's going to be a curse on Google. Any
And
tech
Verizon
stock
was
that goes
out.
into the Dow, it just kills it, man.
No, I don't love the Dow. You guys have taught me that. Okay.
Okay, good.
But I always throw it in because everybody else throws in the Dow.
Yeah.
But all right, your thoughts on earnings? You're our earnings queen.
Sure. I think companies are managing earnings well. And again, I agree with Carrie that energy costs are going to be a factor, and we'll see how well they are able to comprehend the changes in electricity prices. That's just skyrocketing, as somebody that lives in Western Pennsylvania is realizing. But no, I mean, I think that companies are able to well control it. I think hiring has been muted, and I wouldn't expect to see big raises come in the second half of the year either at a lot of these large companies. So I think things will be pretty well controlled. Wild cards are everywhere. The Middle East, geopolitics, and then just, is AI actually ever going to start making an impact into productivity. And I think it's still too early because like you, like many of you guys who are looking for this, I see no big expenses in most companies being allocated to AI, purchasing AI. So we'll see. We'll see.
That's an interesting point. I hadn't really delved into that before, but companies are just sitting on the sidelines waiting to see who's going, which AI vehicle is the best one to use, I guess.
Exactly.
I do think though that like we are starting to see it, just certain, application of AI. And I think that the companies that do start to incorporate it, are going to get ahead. I think from a consumer perspective, especially because the consumer is obsessed with AI, in terms of actually very practical things. Whether it's your Aura Ring kind of analyzing your data and telling you what you need to do to stay healthy. There's just so many applications for it that I'm really interested to see how companies start to utilize it, because I think that's what it's going to take to remain a leader.
Okay. Well, thank you for joining us. So we'll continue our look at investing in the economy in our future editions of The Bull, the Bear, and You. And who knows, maybe we'll talk about numbers once again, since I seem to be fascinated by it and, and other people aren't. But since you're watching or listening to this podcast, I ask that you hit the like or the subscribe button on whatever platform you happen to use. But that does it for right now. Thanks for joining us. We'll see you again in about 2 weeks for the next edition of The Bull, the Bear, and You.